Domino's Pizza is an interesting dividend stock, and a lot of investors are asking if this stock is a buy, hold, or sell. I'll answer that question in this video, reviewing the company's critically important financial metrics and sharing with you my discounted cash flow valuation model for Domino's stock. Let's get right into the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So Domino's has done an excellent job increasing its revenue over the previous decade, growing from $2 billion in 2014, more than doubling to over $4.8 billion in the most recent trailing 12-month period. When you're ordering food for delivery or when you're looking to eat out or not cook for the day, Domino's Pizza is one of the lowest priced options in the market, at least in the United States. You can feed a family of 4 for less than $20, especially if you go and pick up the food. Now, one of the things I'm concerned about with Domino's is increasing competition. The rise of food delivery companies like Uber Eats, DoorDash, etc. makes the competition ever more for when you want to order food for delivery. Previously, pizza delivery was one of the only few options you had available when you wanted to order takeout or when you wanted to order delivery. Now, almost every restaurant can deliver food to your house if you're willing to pay, and consumers have demonstrated that they are definitely willing to pay. So the rise of food delivery poses a risk for Domino's stock investors. On the other end, there is an increasing technology that could benefit Domino's, and that is the driverless car delivery. But more than driverless car, I think, is the robotic deliveries. I've talked a little bit about Serve Robotics, and it's a company that I actually highlighted that could benefit a company like McDonald's, and it can also benefit a company like Domino's. One of Domino's largest expenses and one of its most difficult things to manage is delivery. The number of people it needs to employ and keep employed and schedule, etc. For management, the delivery side of the business has been its biggest difficulty. Especially during the economic reopening here, it's found it extremely challenging to hire and retain employees. And I understand, if you're going to be delivering food, why work for Domino's? I think if I was going to be delivering food, I would want to work for DoorDash or Uber Eats or something like that, where I can choose my own schedule, take days off when I need to, work whenever I want to, and not have someone at Domino's dictate my schedule and my days off, etc. So I can understand why Domino's has found it difficult to hire and retain employees, especially for that specific category. So the growth of those robotic deliveries for food, especially, I find to be something that could unlock a lot of value for a lot of these companies like Domino's, because it makes it more attractive for the business. It also makes it more attractive for consumers because then Domino's can deliver that food to you at a lower cost. Right now, they charge in Los Angeles between $5 and $7 for a delivery fee. So if they can cut that in half, that could make the ordering of pizza a lot more attractive for a lot more people. The next thing I wanted to highlight is the company's operating profit margins at 19% are up from 18% in 2015. And remember, Domino's operates on the franchisee business model, which is lucrative to generating profit margins for the company. Now, the franchisee business model is not all positive. There are some downsides, like the lack of control for some of these locations, and customers could receive a different quality of experience depending on where they are, right? Different cities, different locations could provide different levels of service, and it's difficult for Domino's, the corporation, to control all of its franchisees and maintain a level of control. It is lucrative in terms of returns on invested capital, even though this number has been trending lower at 41%. The ROIC for Domino's for investors is extremely attractive. A 41% ROIC is on the higher end of all businesses that I'm following. The trend line, however, is concerning for Domino stock investors, especially as the threat of new competition is also coming in. So now that we looked at some of the financial metrics, let me share with you my valuation calculation. The intrinsic value per share, which I updated this morning, came to $334 and the current market price is $423. I've felt Domino's stock has been richly valued all year long here in 2025, and I have not had this stock rated as a buy this year, partly due to the increase in competition, partly due to the valuation. Now, even when I measured the stock on a forward price to earnings basis at 23, it doesn't look expensive. It also doesn't look cheap. It looks fairly valued on a forward PE of 23, given its characteristics, given the growth of the business, given the lucrative profitability, given the trends worsening for the return on invested capital and the increasing competition from food delivery and the opportunity from innovative new technology to decrease its cost, improve economies and scale, and make it more attractive for franchisees to open a new location because it's easier to manage. So all that being said, I still don't like Domino stock as a buy, right? I think if you hold the stock, it's reasonable. It will generate reasonable returns over the next few years and over the next few decades. But if you're interested in buying, I would be waiting for a better price. It's certainly a company that I would like to own, but not at these valuations. I would be waiting for a lower price. So I have this stock rated as a hold, and I updated it on September 22nd. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.